All right, stocks still up, but getting a little bit choppy. Kevin Green's looking at the charts for us. At KG, we're trying to hold in there. A bit of a dip in the last 10 minutes, though. We lost about 35 points in S&P futures.
Yeah, a little bit of aggressive selling after the press conference, and usually we actually do see this type of reaction. Either it's a nice little flush to the a pump to the upside after the conference, especially if we've heard something that's been bearish, and then the opposite when we have these really excessive runs to the upside or downside here. What is actually very interesting though is volume is actually fairly light today, Oliver, across the board when you're looking at equities. I mean, I would not even be surprised if we actually have lower volume today than what we had yesterday, even though we have the event risk today. That's kind of where we're at. So light volume, liquidity kind of got drained out of the market for that press conference and the announcement. That's not out of the ordinary right now. And options volume for the most part is coming up a little bit light. But that rejection right around 57.15, we kind of highlighted this morning, 57.20 could be a potential area of resistance for the market. And it looks like we got fairly close to that and then rejected here. 56.60 is a key area for us to be able to hold. Any type of breakdown below that, you're starting to look at around 56.20 to 56.10. Do I believe that we could get down there? Anything's possible. It seems like there's still more excessive call buying that's taking place. The big risk is the unwinding going into the close. The last 15 minutes can be pretty much a make or break. When I mean this, a make or break when it comes to how good the candle actually looks like here today. But we are seeing an intraday bounce. If we go to the levels here, we actually are continuing to keep this megaphone pattern that we have on the 5-minute daily. So yes, we had a flush to the downside here, but we held up where we needed to, around that 56.80 level here. And so if we kind of go back up, test that 5,700 level, maybe we have some pen rest there. If not, and we break down to that megaphone, that's where you get concerned that we might see even a greater flush to the downside here. But we still have some wiggle room, once again, down to that 56.20 where you get really concerned. But decent little pop here today. This doesn't have to do with options flow. I'm actually very surprised to see this type of reaction in equities and then the opposite reaction in treasuries. So you would think that they might balance out a little bit. Maybe you'll talk about that on Risk Radar. But that's kind of throwing me off a little bit because the fixed income market right now, treasury market right now is calling the Fed's bluff. The aggressive buying of paper, given the summary of economic projections, I would say is actually more hawkish than dovish. And we did see treasuries actually look more of a risk-off tone with flows going into treasuries. But the equity market has this relief balance, and maybe they were expecting something a lot worse than what was projected here. But it just seems like there's a massive disconnect, in my opinion, for treasuries and equities, where we should be trading in a yield higher, equities higher environment, not this yields lower, equities higher. That means that we're a little bit more dependent than I would have suspected or expected here.
Well, it definitely complicates it. Right. To your point, that was literally the risk radar from yesterday was looking for today to see stocks up from the Powell put, but also yields up and dollar up. So we do have the dollar up, which I think is helpful. It definitely complicates it, though, because the bonds, of course, have that wacky little feedback mechanism of 10 years where sometimes it's unclear if we're buying bonds because we're scared, or if we're buying bonds because the Fed's not going to do enough, or they're going to do too much. But I hear you in that recently the correlation has been yields up, stocks up. So it's a little bit messy in there today. So if we go to equities just purely from a price action standpoint, if we kind of drop the causality with bonds, a problem to be solved another day. It seems like your analysis is that we want to finish strong. We want to get through some of these ranges to really kind of release tension to the upside. I mean, can we still describe this as kind of a short squeeze? Is that still sort of the one of the ways to describe it?
You can. Okay, so if we go to that the open interest chart where we look at a longer time frame. So this looks like a remarkable pop here today, right? And rightfully so, but we're pretty much at the same levels that we saw on Monday. And actually, it's looking like the same candle. True. We still rejected the gap. We actually tested the gap today. That's something different. That's something new. You would have expected us to continue to go through that gap and try to test 57.30 before seeing a meaningful rejection here. But we're still kind of in this wedge pattern that I actually highlighted earlier this morning, and we haven't officially broken out yet. We still have that gap. We still have the 200-day moving average. We have breadth actually expanding, though. So would I put it to say that the bulls actually have it in their favor right now for the last couple of trading sessions? If we are able to close at these levels, I would say yes, but they still have a lot more work to do, and they're not at the primary short zone in my opinion, just looking at the technicals, you would really like to come back and really test some of these key areas to the upside, and we just have not done that yet. And maybe we'll have some follow through for tomorrow. But this looks like a bear flag. If you're saying that the primary trend over the last month and a half, 2 months has been to the downside, which it has been, and we see a counter trend rally to the upside, that is a bear flag, meaning we have once again, we see that flag right now. So I don't think that we're out of the woods yet. The primary trend still holds, and maybe we get some more buyers kind of step in and break us out to the upside here. But a close today really doesn't change anything from what we saw on Monday, which was impressive on Monday, but didn't have any follow through on Tuesday. Unless,
let's say we get above, the 57, or sorry, I'm looking at the futures. You're looking at the index. If we get above the 5,700, if we could get that little wick, that little candle from, what was that? About 2 p.m. Chicago time, about 40 minutes ago, we got to that high. So to your point, we kind of are dabbling. We're trying to. Hey, real quick, I know you're watching put call ratios. Anything we can glean from that?
Well, you are seeing a backing off, and you're starting to see a lot more call buying activity. Today and yesterday, what was actually very interesting is something called a risk reversal trade. So risk reversal trade is selling a put, and you could do this on the other side too, but you sell a put in order to finance call buying. And you're seeing that same type of pairs trade taking place here. So this put call ratio is moving to the downside. We're below that 1 level, meaning that we have more calls being transacted in than puts. That's bullish overall here. But how long are we going to see this type of risk reversal, which is something that maybe some traders can do this, but it does cost a lot of money, especially on the index side. It does, hinder you on a margin standpoint. How long are we going to really kind of see that? Selling a put premium to fund long calls. You can have a feedback loop the same way to the upside too. That type of strategy does work until you see it, run off. And then that's something to keep an eye on. But put call ratio looks good.
Okay.
Price action looks good. Just nothing that broke Monday's price action. So
I hear that.
I would say stalemate.
Yeah, we're still in familiar territory. With S&P's not able to really crack that 5,700. But all right, well, we got 20 minutes left, and we got tomorrow, and we got Friday, and at least we're stringing together some days without fresh lows for sure. Appreciate it. Thanks, Kevin Green. Good thought on bonds, too. We'll come back to that subject. We've got Colin Martin joining us on the panel. I'm going to hit it in the risk radar. We've also got BTC firming up and holding that 4% bounce.